Welcome to the deep dive. You're here because you want to understand what's been happening with Domino's Pizza recently and get the important stuff quickly but thoroughly.
Exactly. And we've got a good mix of sources for you today.
We do. We've pulled together a snapshot from Guru Focus, an article over at Verdict Food Service, an Investopedia report, and of course the official word straight from Domino's in their Q1 2025 8K filing.
Yep, the raw data.
So our mission today, to really cut through all that noise and give you the key insights. How did Domino's actually do in Q1?
We're looking at the financials, what analysts think, and sort of where they're headed.
Right, let's dive straight in. What's the overall financial picture look like?
Well, the first thing that jumps out is it's a bit of a mixed bag, really.
Yeah.
Revenue came in at $1.11 billion.
Okay, $1.11 billion. How does that compare?
That's up 2.5% compared to the same time last year. And that number pops up across the board. Verdict, Investopedia, the 8K, they all cite it.
So growth. That sounds positive on the surface.
It does, but here's the first wrinkle. That $1.11 billion, while up, actually missed what analysts were predicting.
Ah, okay. By how much?
Investopedia points out the expectation was closer to $1.13 billion. So a slight miss on the top line.
Interesting. So they didn't quite hit the revenue target. But what about profit?
Now, that's where the story shifts a bit. Net income saw a really significant jump,
How significant?
up 18.9% to $149.7 million. Both Verdict and the 8K flag this pretty clearly.
Wow, nearly 19% increase in profit.
Yeah. And importantly, Investopedia notes has actually beat the profit estimates from analysts.
So missed on revenue, but beat on profit. How does that usually happen? Better cost control?
Could be cost management, maybe pricing power played a role. It suggests they were quite efficient, even if overall sales volume maybe wasn't quite what was hoped for.
Makes sense. And that higher profit, did it flow through to earnings per share?
It certainly did. Diluted EPS, that's earnings per share, jumped to $4.33.
$4.33. And the increase there.
A hefty 21% increase. Again, Verdict, Investopedia, the 8K all confirm this.
And I assume that also beat expectations?
Yep. Investopedia puts the analyst forecast around $4 or 4 cents per share. So a clear beat on the bottom line.
Okay, so definitely a win on profitability. Let's go back to that revenue number, the $1.11 billion. What actually drove the growth that did happen?
There were a few key things. One was higher U.S. franchise advertising revenues. That's mentioned by Verdict in the 8K.
Right.
Then you had increased supply chain revenues. This was mainly because they raised the price of the food basket they sell to stores by about 4.8%.
Okay, charging their own stores more for ingredients.
Essentially, yes. Verdict and the 8K mentioned that too. And finally, the 8K also notes growth from international franchise royalties and fees. So their overseas operations contributed.
That advertising revenue piece. The 8K mentioned something about incentives ending. How does that work?
Right. So think of it like this. Franchisees usually pay a percentage of their sales, say 6%, into a shared advertising fund run by Domino's corporate. For a while, maybe Domino's gave them a slight discount, like charging only 5.75% as a kind of temporary help or incentive.
Okay.
In Q1, it sounds like they went back to the standard 6%. That little bit extra from every single store adds up across the whole system, boosting Domino's reported advertising revenue.
Got it. So franchisees are kicking in a bit more to the ad fund now, and that 4.8% price hike on supplies to stores. Any more detail on that?
The 8K says that was the main driver for higher supply chain revenues, but it also adds a bit of context. It says this revenue increase was partially offset because they shifted their equipment and supplies distribution, like ovens and boxes, maybe to a third-party company.
So they outsourced part of the supply chain.
Seems like it. So more money coming in from the food side, but maybe slightly less handling the equipment side directly. Bit of a balance there.
Okay, that clarifies things. Now let's circle back to that impressive profit jump. You said almost 19%. What was the main engine behind that?
The biggest single factor, and this is highlighted in both Verdict and the 8K, was something a bit less about pizza sales. It was a favorable change, about $42.7 million. In the value of an investment, Domino's holds in something called DPC Dash.
DPC Dash, an investment.
Yeah, think of it like a side investment. When its value goes up on paper, it boosts Domino's overall reported profit, even if it's not cash from operations. And in Q1, its value went up significantly.
$42 million. That's a huge chunk of the profit increase. But you said favorable change. Does that mean it's just paper gains for now?
It's an unrealized gain, yes.
Yeah.
So it affects net income, but it's based on the assessed value, not necessarily cash received.
Yeah.
Still, a major impact on the reported numbers.
Okay. But Verdict mentioned something offsetting this gain slightly.
Good catch. Yes, taxes. They had a higher provision for income taxes this quarter.
How much higher?
The 8K breaks it down. Their effective tax rate climbed to 22.3% in Q1 this year, compared to just 15.9% in Q1 last year.
So a bigger tax bite ate into some of that investment gain.
It's exactly. Still a big net positive from the investment, but taxes definitely took more this time around.
What about their actual day-to-day operations, income from just running the business?
Interestingly, income from operations actually dipped slightly, down 0.2%. Verdict and the 8K both report that.
Down, even with higher revenue.
Well, yes, but the 8K gives crucial context here. It says if you take out a $3.2 million negative hit from foreign currency exchange rates.
Currency fluctuations, always a factor for global companies.
Right. If you exclude that currency impact, particularly on their international franchise royalties, their income from operations would actually have been up by 1.4%.
Okay, so fundamentally, core operational income was slightly up, but currency made it look slightly down. That makes more sense.
And there was one other thing impacting that operational income number too.
What was that?
The 8K mentions about $5 million in severance costs. They had some kind of organizational realignment layoffs, presumably, during the quarter.
Right, those one-off costs can definitely weigh on operating results.
Sure.
And drilling down further, what about margins at the store level? Did the 8K say anything there?
It did. For the U.S. stores that Domino's owns directly, not the franchises, the gross margin actually went down by 1.5 percentage points.
Why was that?
The 8K points to two things.
Yeah.
That higher food basket costs we talked about earlier hitting them too, and also lower sales leverage.
Sales leverage, meaning?
Basically, when sales volume is a bit lower, fixed costs like rent or manager salaries make up a bigger percentage of each dollar earned, squeezing the margin.
Gotcha. But you mentioned the supply chain earlier. How did margins look there?
That was actually a positive. The supply chain gross margin increased by 0.5 percentage point.
And the reason?
They cited procurement productivity. Fancy term for basically getting better deals or being more efficient in buying the stuff they need to supply the stores.
So pressure on company store margins, but improvement in supply chain margins. A bit of push and pull.
Exactly.
Okay, let's shift gears to actual sales volume. Same-store sales. I think I saw some different numbers floating around for the U.S. versus international.
You did, and it's a key part of the story. In the U.S., same-store sales actually declined by 0.5%.
Declined? Ouch. That seems significant.
It is, especially because analysts were expecting an increase. Investopedia reported the forecast was for a 0.22% gain.
Wow. So not just a miss, but a swing from expected growth to actual decline. That's not great for the U.S. market.
No, it suggests some challenges there, but contrast that with the international picture.
Which was?
Much brighter. International same-store sales, if you exclude the currency effects, grew by a strong 3.7%.
3.7% growth internationally versus a 0.5% decline in the U.S. Big difference.
Huge difference. And that 3.7% international growth also beat expectations. Analysts were forecasting about 1.88%, according to Investopedia.
So international is really carrying the same store sales growth right now.
Definitely looks that way based on Q1. Strong performance overseas.
What about the total number of stores? Are they opening more or closing more overall?
Globally, there was a small net decline. The 8K says a net decrease of 8 stores in the quarter.
A decrease? How did that break down?
It's interesting. They actually had 17 net openings in the U.S. market.
So still expanding domestically?
Yep. But that was offset by 25 net closures internationally.
Huh. So international sales are strong, but they closed more stores there, maybe consolidating or exiting tougher spots.
Could be. Something to watch.
Mm.
But despite that small net drop in store count, overall global retail sales, again excluding currency, were still up 4.7%.
So fewer stores internationally, maybe, but the remaining ones plus the U.S. stores are generating more total sales globally.
Seems to be the case, based on the 8K figures.
Okay, let's bring in the analysts. What's the Wall Street view on Domino's right now?
Guru Focus had some numbers, right?
They did. They tracked quite a few analysts. The average price target from 31 of them sits at $483.07.
And how does that compare to where the stock is actually trading? Well, Guru Focus noted the price around the time of their report was $494. So that average target is actually suggesting a little bit of potential downside, maybe 2.2% or so.
So analysts on average think it might be slightly overvalued currently.
That's what the average suggests. But it's important to see the range, too.
What's the range look like?
It's pretty wide. Guru Focus shows targets from as low as $370 all the way up to $559.
Whoa, that's a massive spread. Tells you there's quite a bit of disagreement among analysts on where it should be
Yep.
valued.
Definitely. Lots of different opinions out there.
But what about the overall recommendation? Is it generally positive or negative?
Despite that average target suggesting slight downside, the overall consensus rating from 35 brokers tracked by GuruFocus is actually outperformed.
Outperform, so better than just holding it.
Right. The average score was 2.1 on a scale where 1 is a strong buy and 5 is a sell. So leaning positive overall, suggesting they still like the company's prospects long term, even if the current price looks a touch high to some.
Interesting dynamic. Analysts like the company, but maybe not the immediate stock price. Did GuruFocus have its own valuation?
Yeah, they have their GF value estimate. For Domino's, they put that at $471.39 for the next year.
And compared to the $494 price.
That also points to potential downside, about 4.6%. So it lines up with the average analyst target, suggesting the stock might be a bit ahead of itself right now.
Okay, so valuation seems to be a key point of discussion. What about Domino's own strategy? What's the CEO saying?
CEO Russell Weiner, he's emphasizing their hungry for more strategy. He stated in the earnings release, highlighted by Verdict in the 8K, that these Q1 results show it's working.
Working out.
He says it's driving market share growth, both in the U.S. and internationally, even in what he called a challenging global macroeconomic environment.
So they feel their strategy is helping them win business from competitors.
That's the message, yeah. Focusing on gaining share.
And a big part of their recent strategy news was that DoorDash partnership, wasn't it?
Absolutely. That's a major development. Investopedia covered this. It's set to start in May, right after their exclusivity deal with Uber Eats ends.
And Domino's has high hopes for that,
They
right?
have very high hopes. They publicly estimated it could eventually bring in an extra $1 billion in sales.
$1 billion. Just from adding DoorDash. Wow.
Yeah, but getting their menu in front of all those DoorDash customers who maybe weren't ordering directly before, it's a big play to tap into that third-party delivery market they previously avoided.
That's definitely one to watch. Huge potential if it pans out. Okay, before we summarize, any other financial bits and pieces worth mentioning?
Yeah, a few quick ones. Cash flow looked pretty good. Verdict noted net cash from operating activities was up significantly to $179.1 million.
Strong cash generation.
Right. And free cash flow also rose nicely to $164.4 million. At the same time, capital expenditures, money spent on new ovens, stores, tech, actually decreased to $14.7 million.
So generating more cash, spending a bit less on big investments in Q1.
It seems that way. And for shareholders, the 8K confirmed they declared the regular quarterly dividend, $1.74 per share this time, payable in June.
Returning cash via dividends.
And also through buybacks. They repurchased about $50 million worth of their own stock in Q1.
Buying back shares, okay.
Yep, and the 8K notes, they still have authorization to buy back another $764 million worth down the road. So signaling confidence in their own stock value.
Okay, lots of moving parts there. So let's try and wrap this up for you, our listener. What are the key takeaways?
Well, I think it's clear Domino's Q1 was complex. You saw definite strengths, particularly that strong international growth and the big jump in overall profit.
Right, profits were way up, beating expectations. But on the other hand,
that slight dip in U.S. same-store sales is a concern, especially since it missed forecasts. And overall revenue, while growing, also came in just shy of what analysts wanted to see.
and the analyst view reflects that complexity too, doesn't it?
It really does. You've got that generally positive, outperformed consensus rating suggesting long-term optimism.
But
both the average price target and GuruFocus's own valuation metric hint that the stock might be a bit fully valued or maybe even slightly overvalued right now. Potential downside risk in the near term.
so bringing it all together, you've got this picture of resilience, good profit management, strong international performance.
But facing some headwinds in the crucial U.S. market and maybe a stock price that's gotten a bit ahead of the fundamentals.
Which really leads to the big question, doesn't it? How is this major strategic shift, embracing third-party delivery with DoorDash alongside their continued international focus, going to play out?
Especially, like the CEO said, in this challenging global macroeconomic environment. Will the DoorDash boost be enough to reignite U.S. growth? How sustainable is the international strength?
Lots to think about there. We've laid out the key numbers and perspectives from Q1 for you today. Definitely worth keeping an eye on Domino's to see how these strategies unfold in the coming quarters.